Indeed, derivatives markets are truly huge. If you look at turnover, that is the flow of transactions over time, we're talking about 30 times global GDP or about 70 times global trade.
There were quite some telling signs in the patterns of the instruments traded that indicated that it had a lot to do with hedging. And in particular, we saw really very notable rises in the trading of forward contracts. Forwards are sort of really the classical instruments that investors would use to lock in future exchange rates. And we saw that spike especially for trading with financial customers.
What that will give you is some sense of how sharply the elastic band would snap back if something happens. So the more leveraged you are, the tighter you're pulling the elastic band. And so the prescription here would be make sure that you don't tighten it so hard that it's going to snap back really hard. Hello, I'm Hyun Shin. I'm the economic advisor and head of the monetary and economic department here at the BIS.
And I'm Andreas Schrimpf, head of financial markets in MED.
And I'm Goetz von Peter, head of international banking and financial statistics.
And I'm Krista Hughes, speaking from Basel. You're listening to Business, the podcast from the Bank for International Settlements. Every 3 years, the BIS conducts a global survey of foreign exchange and interest rate derivatives markets. Central banks from 52 jurisdictions participate, gathering data from over 1,000 banks. Our latest quarterly review dives into the findings from the Triennial survey, which was conducted in April 2025, a period of heightened policy uncertainty. Joining me today are Shin, Andreas Schrimpf and Goetz von Peter, who, along with BIS colleagues, analysed the recent policy and structural shifts reshaping currency and derivatives markets and what these changes mean for the global financial system. Welcome all of you on the podcast.
Thank you.
Hello, Krista.
So Hyun, to set the scene, how large are these markets and how important are they in the smooth functioning of the global financial system?
Well, the backdrop here is that the global financial system is truly global. We have bond markets, stock markets that are truly, borderless, and there are investors from all parts of the world investing in other corners of the world. In the case of the exchange rate variation, of course, what tends to happen is that investors have obligations to their domestic stakeholders, whether they be beneficiaries in the case of pension funds or policyholders in the case of insurance firms, but they have to have a global portfolio in many, many different currencies. And so to hedge that kind of risk, they would engage in these FX derivatives contracts, which are essentially ways for them to borrow the currency that they need to invest and fixing the exchange rate at the outset. And that way they can at least mitigate one of their risks. Same goes with insurance contracts, and these are actually very, very large markets, and I'll let Goetz explain exactly how large they are. But in a way, what the FX derivatives do is to make money fungible across currencies. So what that means is, I come to a dealer bank and say, let me give you some Swiss francs, and please lend me some dollars, on the understanding and with a contractual obligation that we will, reverse that transaction at a known exchange rate at a fixed point, in the future. That's called an FX swap, which is the mainstay of the FX derivatives market. And they do it because, for these risk sharing reasons, for these risk mitigation reasons. And the crucial intermediaries here are the dealer banks. It's the dealer banks that allow that kind of hedging. And that means that we not only have this geographical intertwining, but we also have the sectoral interconnections as well.
Indeed, derivatives markets are truly huge. If you look at turnover, that is the flow of transactions over time, we're talking about 30 times global GDP or about 70 times global trade. Now, what the Triennial survey measures is turnover in the month of April divided by the number of business days. And in the FX segment, we see turnover has reached $9.5 trillion per day. And that's almost 30% higher than the 2022 survey. And in the interest rate derivatives segment, we have a growth of almost 60%, reaching 7.9 trillion per day. And that's even just the over-the-counter segment, because in interest rate derivatives, exchange-traded turnover is even larger. That adds another 17 trillion in turnover per day. So together, OTC and exchange-traded markets together in interest rate derivatives, 25 trillion. So that's a huge rise over the 2022 numbers. Now we should add that this was in April, and April was a truly extraordinary month for all the policy announcements and the uncertainty going with it.
So there had been a big jump since the last survey 3 years ago, and particularly in the FX trading. So Hyun, what triggered that, and why does that matter?
As you know, April was a pretty turbulent month in terms of financial market action. We had the tariff announcement from the US, and that triggered some volatility in the markets. And we saw this very unusual phenomenon where we had the so-called triple decline, where the dollar, US fixed income securities, US treasuries in particular, as well as the stock market fell in unison. And normally the pattern goes the other way. Normally when there is a risk-off episode and there is a recoiling from risk, normally the dollar would strengthen. What we saw in April was that the dollar actually weakened very substantially. Now, the short story, the FX swap trade actually involves borrowing dollars. The hedging cost is very closely linked to the short-term borrowing cost in dollars. And as you know, dollar interest rates tend to be higher than other advanced economy interest rates. And that's been the case since the flare-up in inflation in 22. And what we observed over the intervening years before the recent survey was that the amount of hedging had been diminishing over time. I guess the other element also is that the dollar had been very strong in the years running up to the April episode. And so that momentum actually also kept investors on the sidelines in terms of the hedging. Why would you need to hedge if the dollar is doing so well? And you can gain both from a stronger dollar and rising dollar asset prices. So what that means is these investors were more exposed to a depreciation of the dollar. Because if you have a dollar depreciation when you're holding dollar assets, then clearly you lose twice. You lose both on the exchange rate as well as on the price. And that meant that the market was vulnerable to so-called ex-post hedging, where investors were trying to mitigate some of their exchange rate losses by engaging in dollar selling ex-post. And in the special feature, we give some pretty convincing evidence. I think there are some smoking gun pieces of evidence there that indicate that ex-post hedging was very much part of this. And so in that respect, the early stories about the demise of the dollar and so on was probably a little bit hasty. It's more like investors mitigating their losses by selling dollars after the event.
And Andreas, how do we know that this volume increase had to do with hedging?
Mm-hmm. Yeah, I would say there were quite some telling signs in the patterns of the instruments traded that indicated that it had a lot to do with hedging. And in particular, we saw really very notable rises in the trading of forward contracts. Forwards are sort of really the classical instruments that investors would use to lock in future exchange rates. And we saw that spike especially for trading with financial customers, so asset managers. There we really saw a big increase. We also saw very large increases in the trading of options. So options are also a hedging instrument that is commonly used. It's also used for speculation, but can be used from the perspective of hedging as well. And then we did see also quite a lot of trading of FX swaps with, again, asset managers, so financial customers of dealers. And as Hyun has previously explained, FX swaps are commonly an instrument where you also borrow dollars at the short leg to fund your position. And some of the investors, they combined also spot instruments with an FX swap in order to establish a forward position to hedge just the increased risk of dollar depreciation. And so all in all, we really saw then very large shifts in exactly those instruments that you would expect are used in order to hedge the dollar downside risk that emerged in this period.
You say that the FX markets were strained but not stressed. How so?
Yeah, in this regard, it's important to consider the market structure in the FX market. And for quite some time, we've been observing that it's highly fragmented. So, and this fragmentation has been giving rise to some, concerns how actually the market would perform if there's really a stress event. And this is especially exacerbated by the fact that nowadays these markets are extremely electronified. So trading algorithms play a key role in connecting these different liquidity pools. These are algorithms either that the banks supply to their clients or also that non-banks use to make markets or to arbitrage. And now, so what we observed in April was that actually this market structure performed relatively well. There was not such thing as a liquidity mirage where this liquidity would retrench. So by all the metrics that we've looked at, we saw relatively good market functioning in these markets given the size of the shock. And so in this regard, we basically say the market was strained but not stressed.
And Goetz, how about the US dollar? Is that still the dominant currency? What do you see from the survey findings?
Very much so. And I think it is nowhere more apparent than in the FX market. The Triennial survey shows that the US dollar was on one side of 89% of trades. And that's even higher than in the last survey in 2022. And indeed, if you look at the most actively traded currency pairs, the first 10 of them all involve the dollar. So you have to get to rank 11 to have the euro-pound pair. And so that really shows that the US dollar remains the world's vehicle currency. So if you need to go from, say, the Swedish krona to the Polish zloty or something, you're likely to go through the dollar rather than through the euro. Now, in terms of turnover, the most important currencies have remained fairly stable in their shares compared to 3 years ago, but there was quite some movement in the second tier. And in particular, the Chinese renminbi has really continued its upward trend. It's now accounting for 8.5% of turnover. And that makes it the fifth most traded currency in the world. And next would be the Swiss franc has overtaken the Australian and Canadian dollars. And when you look at emerging market currencies as a whole, it's thanks to the renminbi and the Hong Kong dollar combined that they now account for 29% of global turnover. So that's quite a gain.
I guess, Goetz, we can also mention the renminbi, the dollar renminbi pair overtaking sterling.
Indeed.
I think that was a pretty important event this time round.
That's right.
And the other part of the survey was the interest rate derivatives markets, and there was another surge in trading activity, up nearly 90% over the 3 years. So, Andreas, what were the drivers there?
Yeah, indeed, it was a very spectacular increase in interest rate derivatives markets, even more so than in the FX derivatives market. One can trace this primarily to some key macro forces, I would say. So the first of it is the increase in interest rate volatility. So, we shifted from this period of ultra low interest rates and also relatively low volatility in terms of monetary policy actions to an environment of much greater volatility after the inflation surge post-pandemic. And so the need to hedge against movements in short-term interest rates clearly increased a lot, and that is reflected in contracts such as overnight index swaps, which allow market participants to hedge against interest rate changes. But also we saw a lot of increase in trading on futures exchanges of products that are linked to such short-term interest rates. So that's one factor. The other macro factor is the massive increase in the supply of government debt that needs to be absorbed. Also on the back of quantitative tightening, balance sheet normalization by central banks. So that led to a significant amount of debt that needs to be held in private hands. And in this regard, one trade that was really in the limelight was the cash futures basis trade, where essentially hedge funds come in as marginal buyers of the government debt. They finance the position in the cash bond via a repo, and then they hedge the interest rate risk via a futures contract. And this trade, it allows them to pocket this small difference, and they lever it up via the repo so that it's profitable. And we also see really the traces of that trade in our data with a lot of turnover in contracts linked to government bonds. Futures contracts. And so what this also has meant is that the segment of futures, the segment of exchange traded derivatives has actually outgrown the OTC segment, which is also quite an interesting development this time around.
And how did the transition from LIBOR to risk-free rates shape activity and sort of market structure over this period?
Yeah, that was also really an important development that it led more to structural changes in the market. Maybe less so had an impact on the actual turnover growth itself, but more in terms of how the markets are structured. Clearly, as background here, what's important is that some jurisdictions, they have chosen a approach where the only reference rate really is risk-free rate, so a short-term overnight funding rates. For example, in the US, that would be the SOFR rate, or in Switzerland, it would be the SARON rate, for example. Other jurisdictions, they've also introduced these risk-free rates, but then at the same time, they've chosen to reform their IBOR rates that have more of the properties that LIBOR used to do. So these are more term funding rates by banks on an unsecured basis. And so now what we see is that in those jurisdictions where the risk-free rates were the dominant rate, we saw the interest rate swaps gravitate to overnight index swaps. So these are linked to these overnight rates, as the name suggests. Whereas then in other jurisdictions, we've seen these OIS contracts coexist with traditional interest rate swaps that are linked to longer-term bank funding rates. There's another development that's also quite interesting. So in the LIBOR world, there was a need to hedge fixing risks, and typically one used so-called forward rate agreements to do that. But with RFRs, or these risk-free rates, it's no longer necessary to use these contracts so much for this purpose. And so we saw quite a big drop in the use of forward rate agreements in the dollar, but still an important use of them in currencies like the euro that has continued to use these reformed IBOR interest rates. And so this also, interestingly enough, means that in the OTC derivatives markets, the euro has actually overtaken the US dollar as the most traded currency in interest rate derivatives.
And Hyun, when you sort of take a step back and you look at the rapid growth of the markets over the last 3 years and these structural changes, the rise in hedging that we've discussed here, do you think that these developments expose any sort of systemic risks or vulnerabilities in the markets?
I think that's a very good question, Krista. And I think what we observe in this triennial survey are really some very important lessons that address these questions. So just to pick up on what Andreas was saying earlier, on interest rate derivatives. So typically, our focus is on so-called over-the-counter, which is the customer to dealer type of transaction. It's over-the-counter in that sense. But as Andreas mentioned, a very important part of the survey this time was on the exchange traded. So what that refers to is a set of products which are standardized. They have a fixed maturity date, perhaps every month or every quarter. And so that enables trading in various centralized marketplaces. And the futures contract is a very, very important contract. Now, as Andreas was explaining, this is used by hedge funds to construct their leverage portfolio. So what they do is they buy very large amounts of fixed income securities, in particular US Treasuries, but they finance it by borrowing from dealer banks or from other venues, but they pledge those securities as collateral. And we know that they can borrow on very favorable terms. Typically, the haircut will be zero in those types of transactions. And so there really isn't any upper limit imposed by the creditor on the feasible leverage. But in order to control for the price risk, they would take a hedging transaction in these futures markets. So they would actually go short in the futures market in order to hedge their very large treasury portfolios. And these positions are actually very, very large relative to the equity capital. And the reason why we should think about all of these markets together is that it's the same dealer banks that are operating both in the repo market, in the fixed income security, collateralized lending market, as well as the FX swap market. So if one segment experiences turbulence, we would see a knock-on effect on the other leg as well. And that's exactly what we observed during the great financial crisis of 2008, as well as the COVID stress period in March 2020, when there was a problem in the fixed income markets. We also saw the FX derivative markets freeze up. Essentially, nothing would actually trade, and so this called for the central bank swap lines in order to unlock these markets and bring markets back into some kind of normalcy. So these are the types of scenarios that we should be concerned about. And our general manager, Pablo Hernandez de Cos, gave a speech at the LSE last month. It's the interconnections between these different markets that's actually very, very important for us to consider when considering systemic risk, because trouble in one corner of the market will have repercussions in other corners of the market. And it's the same players that are actually very active in both. And if you read his lecture, you'll see that there are some prescriptions that he lays out. They are essentially all measures that try to mitigate the degree of leverage in the system, so that we don't have the stress that might flare up when there's an unwinding. But these are things that we, I think, have to bear in mind when we look ahead to potential stress scenarios.
If I could just complement what Hyun said, just with 2 points. I would say it's important to also look at some of the more obscure corners in the market with the cash futures basis trade. That's really been on the radar now for quite some time, and we have very good data by the CFTC on the positioning of hedge funds in this market. But there are other obscure parts and relative value trades where we don't have such good insights and can't track these positions that much. And this is in particular the so-called interest rate swap arbitrage trade, where there can also be very large positioning by hedge funds. And in a box that we have in one of the articles, we assess the magnitude of this trade. We infer it based on a multiplicity of data sources. And it does link up also with the arbitrage opportunities that are in fixed income markets and are linked to, as I mentioned before, the large amount of government debt that needs to be absorbed. It's important to also track these on top of the typical cash futures basis arbitrage trade by hedge funds, because they're similarly vulnerable to changes in margins, in the haircuts, in repo transactions, as Hyun mentioned. Indeed, there were signs in April 2025 that these trades were under pressure when margins rose and deleveraging pressures kicked in and generated some selling of U.S. Treasuries, leading to upward pressure in government bond yields.
And are policymakers currently able to monitor these developments well enough, sort of in real time or near time, or are there measures that could be taken to help this?
Well, I think for market prices, this is real time. You can see what the prices are doing, but I guess prices are not going to reveal everything about the underlying vulnerability. For the underlying vulnerability, we have to keep track of things like leverage, and for that reason, we have to keep track of things like the haircuts that are demanded by the lenders. In that there's basically a one-for-one relationship between haircuts and the total leverage, and what that will give you is some sense of how sharply the elastic band would snap back if something happens. So the more leveraged you are, the tighter you're pulling the elastic band. And so the prescription here would be make sure that you don't tighten it so hard that it's going to snap back really hard.
Thanks to our guests, and thanks very much to all of our listeners as well. You can find the results of the Triennial survey, our quarterly review, and the text of the LSE lecture on our website at bis.org. Please follow Business on your favourite podcast platform, and you can keep up with what we're doing at the BIS on LinkedIn, Instagram, YouTube, and X.